Hello guys, so we are going to discuss today options and derivatives. So again, this topic is 6.4, meant to say it's unit number 6 and topic number 4. And this unit number 6 belongs to corporate finance section. And you know the corporate finance section is the 20% of your exam. So this topic is related to corporate finance section, options and derivative. So first I'll start what is the definition of derivative, and then we will discuss what is the option contract, because in derivatives we have different types of contract, so that I will tell you the passage of time. So let's start with the definition of derivative. So it is little bit hard if you will just go through your book only. One three four lines are written only so to explain the derivative, but I'll spend maybe 15-20 minutes for initially to explain what are the derivatives. Okay, and then we'll see the types and we will start studying the types, different types of derivatives. So here we go. So first of all, we have a definition of derivatives. So there's the first definition, because I'll show you two definitions of derivatives. So derivative instruments. So instruments, you can assume these are contracts, okay, simply. So derivative instrument is an investment transaction in which the party's gain or loss is derived from some other economic event. For example, the price of a given stock, or a price or the foreign currency exchange rate, or the price of certain commodity. Okay, so this is really difficult what they are trying to say. So first I'll tell you here, it is actually an investment transaction or financial transaction, okay, in which parties gain or loss. Parties means obviously there will be a two parties in this contract, okay, because it's a contract. So there will be two parties. So assume one party will be seller, other party will be buyer, so that I'll show you with help of example also. But we will calculate the gain or loss for the parties. So this gain or loss is derived from some other economic event. Other economic event is what? For example, the price of a given stock. Let's assume if you are trying to buy or sell the stocks, okay, through the contract. So then the gain or loss on the contract you will drive from the price of the given stock. Okay, it is little bit really difficult. So let me show you example and then I'll come back to this definition. Then 100% you will understand. So here we go, starting with the example here. So because derivatives we are using for hedging purpose or for speculation purpose, that I'll show you later as well. So let's start with the help of example. For example, imagine if you are a farmer. So let's assume you are going to grow, or you have already grown the wheat, okay, and wants to lock in a price to protect against falling price. So for example, if you are seller of wheat, maybe this wheat will be available, let's assume after 6 months or after 3 months. So it is not yet ready. It is not yet harvested. Okay. So it will be ready maybe by 6 months. And what risk you are facing? So you are the seller of the wheat. Okay. So what risk you are facing? So risk is that after 6 months, by the time when the wheat will be ready, so what may happen? The price of wheat might go down when after 6 months, once the wheat will be ready. Okay. Now, this is what is the risk to the seller or to the farmer. Now, on the other hand, we have bakery business. Obviously, bakery business, they bake the items, so they need what? They need wheat, for example. So now we have here another business, because I'll keep writing and I'll explain here. So here we have another buyer. So buyer, who is the buyer? The bakery business, because they want wheat. For example, they want wheat in 6 months. Let's assume they want wheat in 6 months time. And and the risk for the buyer or for the bakery business is that the price may go up by the time of 6 month, by the end of 6 month, right, when they will actually purchase. So at that time prices could be higher. So this is risk is to the baker. Now what they are going to do? Now guys, please remember, today, for example, today I'm just assuming. So the this is this is today, I'm now saying today. So today the price is $200 per ton of the wheat. This is the today's price. Okay. But after 6 months, so the seller is thinking that the price may go down maybe below the $200 per ton. And the buyer is thinking that maybe the prices will go up, okay, maybe above the $200. So both they are feeling that this $200 is the appropriate price per ton. They're thinking, seller is thinking this is a good price, it may reduce in future. Buyer is also thinking it is good price, it may increase in the future. Now what? So what they will do today, for example, they will enter into a contract, okay, and in that they will lock the price. They will lock the price of $200 per ton, for example, per ton. Now they have locked the price. So what will happen now? Please, you have to understand. So now let's assume after 6 months, once actual time will come to buy or sell, for example, let's assume after 6 months, if the price is $220 per ton in the open market. Now here you have to think who is getting gain and who is getting loss. Okay, so here guys, please, because this is the binding contract I am assuming so far, binding contract, because they entered into contract. So I'm just for the sake of assumption, I'm just assuming that this is a binding contract. Both parties have to fulfill their responsibilities. Seller has to sell the wheat, buyer has to buy the wheat. Now let's assume if after 6 month price actual price is $220 per ton. Now tell me who will get a gain or who will get a loss. So I'm just explaining here. Obviously the seller will get a loss here of $20 per ton. How? Because if he will sell in the market, open market, so he can get $220. But because he had already entered into the contract, so that is why he has to sell at $200. So now he will lose $20 per ton, right? And on the other hand, if you will think from the buyer point of view, so buyer will be in the gain here in this transaction. $20 per ton. How? Because if he would buy from the open market after 6 months, okay, so obviously he will pay $220, but he is buying through the contract. He will just pay $200. So it means $20 he is paying less. So it is a gain to the buyer, right? Now we can change the situation as well, right? So situation is, for example, if what if after 6 months, so price becomes $180, let's assume instead of $220, now price is $180. Now what will happen? Because now here seller will be in the gain. Why? Because if he would sell in the market, he will get only $180. But if he would sell through the contract, because it's a binding contract, so he is selling at $200, so it will become now again $20 per ton for the seller. And if you will think from buyer point of view, buyer will have a loss of $20. How? Because because if he would buy from open market, so he can pay only $180 per ton, but now he has to pay $200 per ton due to this contract, so he will lose the money now, right? So this is what is, guys, uh, gain or losses are calculated based on what? Based on the actual price of something else. Actually, this gain or loss we are calculating for the contract, right? Which we have entered. But this, while we calculate the gain or loss, so we actually compare our contract price with something else, right? Something else means the price in the open market. So then we get the gain or loss. Understood? So this concept is the definition of derivative. So this is what is written here. Now, if I'll take you to back, so you can just go through here this scenario. I have already explained this scenario, this example, and the result. This I have already explained to you here, guys. Okay. So was just while you will watch this video, obviously you can pause and go through the story what's written here. So then, guys, now if I'll come back to the definition, now it means we can understand the definition very easily. So see, so this contract derivative, it is a contract or it is an instrument, okay, so or it is an investment transaction in which parties gain or loss is derived, just you have calculated gain or loss from some other economic event. And what was the economic event? The price of the given commodity. Understood? So please remember these kind of contract, right? So when you are making these kind of contracts, right, to sell the stock. Maybe you are selling stock through the contract, or you are buying stock through the contract, or maybe you are selling foreign currency through the contract, or you are buying the foreign currency through the contract, or maybe so you are dealing with a certain commodity. So all these things, stocks, foreign currency, commodity, even interest rate, so these are called underlying assets. Underlying assets, right? It means the contract value will change, or you will get the gain or loss based on the actual price of underlying assets in the open market, right? So this is the first way to define the derivative instrument. So now I'll tell you here another definition which is written here. It's another definition or a derivative instruments. Okay. So this another way, just it's the same thing, but we are using slightly different words here only. So, but please remember in your book, this definition is written. Okay. This one is written in your book. So this I'm explaining just for the sake of understanding, because this is quite common definition, okay, which is written in almost overall in books. Okay, so what is derivative instruments? So derivative instruments is a financial product. Again, you can say financial contract. Okay, whose value means say this contract value depends on what? Depends on, or is derived from. In simple words, the contract value is depends on what? On the value of something else, or on the price of something else in the actual market, right? So, or we can say these are the contract whose value is derived from the value of something else, called underlying assets. And I told you already what are the underlying assets. Anything which you are trying to sell or buy through the contract, so that is called underlying assets. So it could be a stock, it could be even bonds, it could be a commodity, maybe rice, wheat, etc. Okay, it could be a crude oil, etc. It could be a foreign currency, it could be interest rate, or it could be a market index also. Understood? So now here, now just slightly, I'm giving you another example how the contract value is derived, okay, from the value of something else. So this definition I'm trying to justify with the help of example now, because guys, even see, look at here. So there's a one derivative market, okay. Derivative market means say, because some derivatives are exchange traded, so we can trade like, I'll show you with the passage of time, like future contracts, option contracts. So these derivatives or these contracts are tradable. You can like, trade. You can buy and sell frequently, okay? Like as you are doing trading with the stocks, you can buy and sell. So some derivatives are also not tradable also, but let's assume these are tradable derivatives, okay? So then we have an open market. See, open market, like if you have a commodity, so contract of commodity, like you will buy or sell the commodity at fixed price. So this you will do in the derivative market. But there is an open market, for example, the market in which you can practically go and sell your commodity, or you can buy the commodity, right? This is the open market. I'm using word open market for it. And derivative market is what? Where your contracts are trading. So please remember here, guys, please remember here, these two things always move in opposite direction. Okay. So for example, I'm just saying few words. If you are getting loss here in the open market, let's say if you are seller and you are getting loss here, why? Because you are seller, right? You want to sell something. If you will sell in the open market, let's say you are having loss. Why it's a loss? Because maybe the price has gone down. Let's assume you are selling, right? So you are selling, I'm saying that you are selling in the open market, okay? So you are selling in the open market. So if let's assume, I'm not saying the word if the price is going up or going down, so ignore this because it will confuse you. So just I want to tell you one thing. So the thing is that, so you will, if you have a loss in the open market, what will happen in the derivative market? Automatically here you will have a gain, okay? Gain in the derivative market. Okay, so this gain or this loss will be offset, okay? Offset. This will be offset. Or in other words, if you are having a gain, okay, in the open market, so here definitely you will have a loss. So this gain or this loss will be offset, right? So this we will do in the hedging, by the way. So but I'm moving to the so you have to remember one, what is the main point? You have to remember these two things moves in opposite direction. Okay, if you have a loss on one side, you will have a gain on the other side. If you will have a gain on one side, you will have a loss on the other side. Just for the time being, remember this sentence only. Okay. Now, now guys, here I was telling you, derivative instrument is a contract whose values, okay, is derived from the value of something else, which is something else is underlying asset. So we have an example here. I'm just showing you example. Let's read it and let's go through the situation. So situation is, what is the situation? It's just a definition I'm explaining, okay? For example, you buy a future contract. So future contract is one of the derivative, okay? So far don't bother about this word future, okay? Just remember you bought a contract. It's a binding contract. You bought a contract to purchase gold. In the contract, you are signing the contract that you will buy gold at $1,800 per ounce, okay? And you, but when you will buy gold in 3 months, it means the contract is here you have you are a buyer, for example, and here we have a seller of the gold. Seller, buyer of gold, and seller of gold. I'm using word. Okay. So you bought a contract that you will buy. You have agreed with the seller that you would buy a gold at 1,800 per ounce. Okay. This is what you have agreed. Okay. Now how it works. The contract locks in this price. You lock this price 1,800, meaning you agree to buy the gold for 1,800 per ounce when the contract expires. Okay, so like you are saying that at the end of contract, whatever the duration of contract is there, you will buy the gold at 1,800. This price you have locked. Similar example I have quoted there, but here I'm just adding slightly more information. Okay, so this price you have locked. Now price changes and impact on contract value, because this contract value will change automatically. Okay, value, how it will change? Obviously, if you will have a gain as a buyer, value will go up, or if you have a loss, value will go down. So that I'll show you. Don't worry. How contract value will change? They're saying if market price rises to 1,900. Okay, now we have to understand the concept here. Let's assume in the this market price means actual market price. For example, if actual market price has increased to $1,900, I'm just writing here. So actual market price is $1,900. Now tell me, for the buyer, if you are a buyer, if you will buy through the contract, which is for 1,800, you have a gain or loss? Obviously, you will have a gain, right? Gain of $100 per ounce. How? Because if you will buy from the actual market, so you will pay 1,900. But if you will buy through the contract, you will pay 1,800. And obviously, if you will buy from the contract, you are saving $100. So this is gain to you. And think from the seller point of view now. Seller, if he would sell in the open market, so he can sell for 1,900, but now he's forced to sell at 1,800, so he will lose $100, right? So it means if there is a gain to one party, definitely there will be a loss to the other party, right? Now here, because if, for example, if this contract is with you, which is for 1,800, now this contract will grow in value automatically. Why? Because even if you will sell this contract to other person, okay, even if you will transfer, let's assume, this contract to other person who can buy this gold, he will happily pay you more than 1,800 per ounce, right? Because he knows in the market rate is 1,900, and he can buy it through the contract only for 1,800. So there is a gain, right or wrong? So there is a gain, so automatically contract value will change, because when contract trades in the market, so it will be traded at gain. So because there is a gain, right or wrong? So then now have a look here. So let me come back to the main discussion. The main discussion was you lock the price 1,800. Okay, and now the actual market price in the market is 1,900. We know the buyer is going to have a gain of $100 and seller is going to have a loss of $100 now. But let's go through this one also. Look at here. They're saying if price rises to 1,900, so what will happen? So your future contract is valuable, as I told you, because it allows you to buy gold at 1,800, even the price is 1,900 in the open market, but you can buy at 1,800, right? So, and immediately if you will buy at 1,800, and immediately if you would sell in the open market, so you can get a gain. That's why I told you buyer has a gain here, right? Buyer has a gain. Okay, this gives you potential profit of $100 per ounce, right? Okay, now look at here. If market price falls to 1,700, okay, but you have locked 1,800, right? You have locked 1,800. What if the market price will become 1,700? Now, obviously, it will become a loss to the buyer. It will become loss to the buyer, and it will become again to the seller. Why? Because you locked price 18,000, 1800, but if the price actual price is 1700, so you have to buy through the contract, because let's assume it's a binding contract. So what will happen, guys? So you are paying $100 extra, so this is loss as compared to the market, right? And here he is getting $100 extra as compared to the open market. It's again to the seller now. So this is what is next story. What if the price falls to 1700? Now your contract has decreased in value, so your contract value will decrease, because even if you will sell this contract, uh, because you have agreed price 1800, so but you will not get 1800 while you will sell this contract, because there is a loss, right, that you have to bear. So contract value will go down automatically. This is what they're saying. So now your contract has decreased in value because you are obligated to buy gold at 1800, but actual market price is 1700. So this 1800 which you will pay because you have agreed, which is higher than the market price, which was 1700. So you face a potential loss of $100 per ounce. Now we have here a note. What is note? In each of these examples, because I have shown you two examples. One examples were for farmer and bakery, and second example is for the gold, right? So in each of these examples, the value of derivative contract, or simply value of contract, okay, whether it is future contract or is it option swap or forward, don't bother about these words. So value of the contract changes in response to the market condition, right? And profits and loss result from how the price of underlying assets moves relatively to agreed upon terms in the contract. So this is what they're saying. The profit or loss you will calculate, and it depends upon the movement of the price in the actual market. Right or wrong? So this is what is derivative. Now, guys, this was just definition. I'm not sure they will ask the definition in your exam or not, but what they will ask, that I'll tell you. Okay. Later I'll tell you, okay, from here you may face question in your exam, so that is more important. So this is all about, it was just about definition. Now here, why we use derivatives? Okay, so we have primarily two main reasons to use the derivatives. Okay, the contract which we do. Okay, because there is a specific derivative markets are there, so these derivatives are traded there. For example, in USA we have a Chicago Mercantile Exchange, so there these derivatives, these contracts you can trade. Okay, now, so there are primarily two main reasons to use the derivative. One is called hedging. Hedging, I'll explain what. So hedging is what? So here you are reducing. Hedging means that you are going to minimize your risk of adverse price movement. Okay. For example, as I gave you example previously, for example, if you are a farmer and you think that in 6 months the wheat price will go down, right? So you can minimize this risk by entering into the contract with someone and you can lock the price, right? So hedging reduces the risk of adverse price movement, okay, in the underlying assets. So here, when while we do hedging, our objective is to minimize our risk of adverse price movement. Okay, adverse price movement means the price movement which can give you loss. So we want to minimize that loss. This is called hedging. Then speculation. Some peoples, they just enter into the market for speculation reasons. Speculation reason what? They want to make money. As you invest in the stock, and while the stock price will increase, so you will sell so you can make a profit. So similar way, some speculators, they use this derivative market just to make up profits, right? Based on the price movements. If price will change, obviously they will have opportunities to make profit as well as losses as well. But their objective obviously to make profit, not the losses. But losses may be there, right? Because when you trade, so obviously you may have a loss as well. So now, guys, here we have a note. Generally, when we deal with the derivatives. So if there is a contract, right, to buy or sell something in the future, so generally there are two parties, and mainly, most probably, I'm saying that one party, okay, could be the speculator, and other party could be the hedger who want to avoid risk. Speculators, he want to take risk and make profit, and hedgers, he want to minimize risk of adverse price movement. Okay, forget about it, but just I told you. So now I'm going to tell you from where your questions testing will start. So mainly from here it will start. Okay, because in your book, after definition directly they are trying to explain what is hedging, and then they are telling you in your book what is long position and what is short position for hedging, because hedging is our main topic. Okay, and from here they may ask you what is hedging, or what is long position in hedging, or what is short position in hedging. So from here you have to remember these terminology. So here we go. Please remember here hedging. What is hedging? Hedging is the process of using offsetting commitments. Like commitment means like contracts. So you will use contracts in such a way that loss on one side will be netted off with the gain on other side. One side means open market, other side is derivative. If you will, as I told you, they always move in the opposite direction, right? So if you will have a loss in the open market, so you could have a gain in the derivative market, and if you have a gain in the open market, you would have a loss in open market. So you are using offsetting commitments or offsetting contracts, so where loss will be netted off against the gain on other side. And our purpose is what? To minimize or to avoid the impact of adverse price movement. In simple words, in hedging, we are using offsetting commitments which will minimize our risk, simply risk of adverse price movements. Okay. So now, guys, here we have here. This is just again continuation of hedging, just a definition. If you will just go through your book, what is long position? Only two lines are written. So, but I'll explain with the help of example what is long position and what is short position for hedging. Okay. So these two terminologies can be tested. So here we go. First of all, you should remember here when we say, oh, we have a long position in the derivative market, or we have a short position in the derivative market. Actually, it's a language which we use, right, in financial market. So please remember when we use long position, or what is the purpose of long position. So please remember here, long position is used when you are worried that prices will go up in the future. So it means here I can say that if you want to buy something in the future, you want to buy something in future, something in future. Okay, for example, maybe you want like a bakery, you want to buy a maybe wheat in the future. So what is the risk to you? So the risk is that the price will go up in the future. Okay, in the future means after 6 months maybe price will go up. So in that scenario, if you want to protect yourself from this risk, from this risk, if you want to protect, so you have to take a long position. Okay, long position, how you will take? Obviously you will buy a contract and you will agree the price and you will lock the price. This is long position. So here they are telling you, first of all, this is what they're telling you. So long, what's the purpose? Long position is used when you are worried that the prices will go up in the future, and especially if you are a buyer, if you want to buy something in the future, so long position is used by the buyer. Okay, then what, how it works? How it works. So please remember, first word you have to remember here, long positions are used by the buyers. And here, when why you are using the long position? Because you want to protect yourself, right, from the price increases in the future, because you want to buy something. If the price will increase in the future, you will lose money, right or wrong. So that's why you want to protect yourself. So please remember, first word, long positions are used by buyers who want to buy something in the future. Something means any underlying asset, commodity, stock, gold, etc. How it works now? So you buy a future. Again, remember a future. It's a future contract actually. So you buy. Ignore the word future. Let's say you bought a contract or options. Ignore the word. So let's say you bought a contract, locking in the current price, because you have. Let's say current price is $500. Okay, but your risk is that the price will go to up to $600. So that's why you want to protect you from adverse price movement. Now what? So you will lock this price today. Okay, then what? This price you are locking today by entering into contract. Now look at here, example here I'm discussing here. For example, imagine, it's another example, kind of similar concept, but you have to go through everything. So let's say we have a situation. Let's imagine you are airline company, so that will need fuel in future. So you need a fuel in future. Okay, maybe after 3 months. It is it's worried that fuel price might rise by the time it's it needs to buy. Maybe in 3 months, the risk is that price will go up. Okay, this is the risk to the airline industry because they want to buy fuel. Hedge what? The airline takes a long position because they are buyer, right? They are going to be a buyer in the transaction. So they will take a long position in fuel futures. Futures mean to say in contract, they will take a long position. So ignore this word. So they will buy a contract locking in the current price of the fuel, right? And what is the outcome now? Because they locked the price. Because there are both possibilities are there. The price, if the price will go up in the future, I would say in the open market, the price will go up, so you will have a gain obviously because you have locked the price. What if the price will go down, so you will have a loss, right? So this is what they're saying. So this is the outcome now. If price of the fuel rises in reality by the time the airline needs, so the future contract helps them to buy at lower price. Lower price means say whatever the price you have locked, so you can avoid the increased cost, right? Obviously, as I told you, if in reality price will go up in the open market, so you will have a gain. This is what they're telling you. What if the price falls? If the price will fall, the airline might face a loss on the future. Okay, because in the actual market price is less, but you have to pay more. But it can be the cheaper fuel in the market, partially offsetting the loss. So this is what they're saying. Because if you will have a loss, okay, for example, if price will fall, as I told you previously, so you have a loss on the contract because on the contract you will have a loss, right? But on the open market you will have a gain. So what you will do here now? How hedging will happen here? This is the question. What you will do, guys? So you can actually, please listen me here carefully. I'm going to say very important statement. So if prices has reduced, what you will do? So then what you will do? So you should actually buy from the open market. Let's assume price you locked price $100, but the price in the open market now it becomes, let's assume, $95. So what you will do? So you will buy at $95 from the open market. So here you saved $5, right? But in the derivative market you will lose $5 because okay, so you will lose $5. So this gain and this loss will be automatically offsetted. And please remember one more thing, people are always confused. Mostly derivative market we use only for gain or losses. We don't deliver or we don't buy goods physically. Okay, just we take gain or loss. If you have a gain, you will collect the money from other party. If you have a loss in the derivative market, you will pay the money to the other party. And you don't need to pay directly, so exchange is involved in between. Okay, exchange is involved in between. So they will take money from one account and they will transfer to the other account. Okay, so derivative market just we use to gain or loss purpose only. But you can buy the things actually from the open market. Okay, if you will have a loss in the open market, you will definitely have a gain in the derivative market. They will net off. That's why I told you they both will move in opposite direction. Okay, so here, so a long position helps protect against price increases. How helped you long position to, this is the final statement. How he protect you against price increases because you agreed the price, right? You agreed the price $100. If price is $120 in the open market, still you will buy as airline industry at $100. So you can protect yourself, right? You can protect yourself. So this is simply gain, right? But if what if price will go down? So then you have to do what? So you should buy from the open market. There you can have a gain because you can buy at 95, and then just here you save some money, and here you lose some money on the derivative market. So the saving on one side will be netted off with the gain on the side. So this will become hedging for you. Okay, now we have a short position. Previously, I told you long position. I told you long position is taken by buyer. So here I'm telling you short position is taken by seller. Okay, and for seller risk is different. But seller risk is that the price may go down in the future. Okay, so please remember here, if you are a seller in the transaction, so you have to take a short position. So short position for hedging is what? Short position, what is the purpose first of all? Short position is used when you are worried that the price will go down in the future. For example, let's say if you are a seller. I know I spent maybe 30, 40 minutes on the explanation of these terminology, but it was really important. Okay. For example, you want to sell something. Okay, let's assume current price is $100, and the risk for you is that okay, the price after 6 months will become maybe $90. So this is risk to you that price will go down. Okay, now what they're saying that how it works. So here we have example for that situation. A farmer will harvest wheat. I give you similar example in few months and wants to ensure the good selling price. So they are worried that the wheat price might drop. As I told you, price will go down, right? Why the wheat price might drop by the time of the harvest. Okay. So now what he will do? Hedge. How he will do hedging? The farmer takes a short position because he's the seller. He will take short position in wheat contract or in wheat future. So he will sell a future contract locking in today's price. For example, today price is $100, so he will lock this price. Now outcome. What is the outcome? If the price of wheat drops, if in the price of the wheat, for example, if price is going to be $90 after 6 months, let's assume, if price of wheat drops by the harvest time, let's assume it is $90, so the contract gains in value because why you can sell at $100. As I told you, derivative contract we don't use for physical transfer, just we take a gain or loss. What if price is $90? Here, the seller will have a gain. Why gain? Because he is selling at $100 at the lock price. And here the buyer will have a loss of $10, right? Here he's having a gain. So the party who is in the loss, the exchange will deduct amount from his account and he will credit to the party account who is having gain. Okay, this is what they are trying to tell you. Understood? So this is what if the price of wheat drops by the harvest time, the future contract gains value, offsetting the loss from the lower market price of the wheat, right? Because guys, if now think this way, if the price is going down, okay, in reality is 90. So obviously you will have a gain in the future market, right? In the derivative market, because you are selling at 100. But assume if you are in reality, we are selling in the open market. So you would sell at 90, right? So here you got a loss of 10 because price is because you are selling at 90, right? Here you got a loss because $10 you are selling at less. But here you got a gain in the derivative market. So this loss and this gain will be net off and it will become your hedging. This is what they are trying to tell you. Okay, guys, I know it is too complicated, but this is how it works. So now here we have this is the key difference about long position and short position. So please remember long position. I told you who is taking long position. Long position is always taken by buyer, right? So long position for hedging protects against future price increases. And obviously, who is having this risk that the price in the future will go up. In the coming time, it will go up. The price in coming time. It obviously buyer is having risk, right? If you are buying something, so then you will have a risk. Oh, the price may go up in 6 months. This is the risk to you. Short position is always used by seller. Okay, always used by seller. Okay, and short position we use to hedge what? We want to protect ourselves that the prices may decline in the future. Obviously, if you are selling something, so your risk to you is that maybe after 6 months price will go down and you want to protect for that. So please remember these two statements finally. Okay, long position is taken by buyer and short position is taken by seller. And long position will protect you against future price increases, and short position will protect you against future price decline. So this is the statement you have to remember. Okay, this can be tested in your exam also. Understood? So from all this discussion, what you have to finally understand, or you should keep in your mind, you should understand what is derivative instrument, and then you should remember what is hedging definition. It's offsetting commitments, right? And then you should know what is long position and who is taking long position and how or against what you long position will protect you, right? Then what is short position? Who will take short position and against what he will protect you? Short position will protect you. I mean to say, okay. So now, guys, here we have example. It's again one example because here actually I want to explain 2 3 words or otherwise this example because the mark to market etc initial margin variation margin, so these are linked with specific future contracts, so I'll explain it there. No worries, so we don't need to go through this. So now guys, here we go. Types of derivatives I'm starting. How many types of derivatives are there? So guys, derivatives means a contracts. So derivatives are also called financial instruments because financial instruments mean to say it is the asset for one party and liability for other party. Okay, so derivatives. Please remember here derivatives. We have over the counter derivative and we have an exchange traded derivative. Exchange traded means that those derivatives which are tradable on the exchanges like stocks, bonds. So those are options and future. And we have then over the counter derivatives which are swaps and forward contracts. Okay, so don't bother. So we'll start with the options first. These are exchange traded and these we'll see in the future. Okay, in coming class. So exchange traded, we are discussing those contracts which are traded on the exchanges, right, like a Chicago Mercantile Exchange. Okay, so first I'm starting with the option. So what is option? And from here your testing will start obviously in your exam as well in the option contract. Okay, so for what we studied, so you have to remember derivative definition, hedging definition, long position, short position, and then you have to remember these things. Okay, what is option contract? So here we go. I'll start with the option. So let's see how much we can cover here. So please remember, first of all I will tell you very basic simple definition. Okay, so then we'll go through the proper definition. So here is the definition here. Simple. Simple definition. I'll start with the simple first. Option is what? Option simply means you have a right. Okay. Right of what? Right to buy something. Okay. Or right to sell something. So that is the simple word I said, but here we go. It is a contract between two parties. Okay. Option is a contract between two parties to buy or sell anything means a stock, bonds, commodity in future date at specified price. Like here what? Your price is locked. Okay, you will lock the price today and this transaction you will perform in the future. For example, if you want to buy some things or you want to sell something in 6 months time, so you can lock the price today. Okay, and this contract will be between two parties. This is simple definition, but this is the real definition here. And I'll read it first. Maybe few words you will not understand and then I will tell you through the help of examples, so then you will completely understand the definition. So here options options contract, okay, is a financial derivative because it's a part of derivative. It's a contract that gives the holder, this is the keyword here, holder. Who is the holder? Holder of contract. That gives the holder the right, but not the obligation. Okay, it is your right, not the obligation, to buy or sell an underlying asset at specified price. Specified price is called strike price on or before a certain date. See, there are few words. Financial derivative means it's a contract. Okay. A contract will be between two parties. Okay. And in this contract, one party will be a holder. Okay. And the holder of the contract will have a right, not the obligation, right to buy or sell an underlying asset at a strike price. Let's understand now in more detail. So then we'll come back to this definition. So I'm going to start first two parties because I have to explain first who is holder. What is holder here? Contract holder. Holder I'm going to explain. Okay, so guys, in the contract there are two parties here. So please listen me carefully now. There are two. This is the contract in between two parties, right? So there are two parties. Two parties. One is called option writer. Option writer is also called seller of contract. Please remember, guys, seller of contract and seller of commodity or product. These are two different things. Don't think it is a one thing. No, these are two different things. You will understand what I'm saying. Let me explain first. On the other hand, other part is called option holder and buyer. Its holder is also called buyer of contract. Please remember again, buyer of contract or the buyer of commodity. So these are two different things again. Okay. For example, I'm taking a contract from you. It's a buyer of contract. Maybe in that contract it's written, I would sell you something, right? It may be written right or wrong. So that is why, please remember, buyer of contract or buyer of commodity, these are two different things. Seller of contract and seller of commodity, these are two different things. So let's start now. Here, option writer is called seller of contract. So now let's understand who is the option writer. Who is the option writer? So please remember here, option writer is a person or entity who creates or sells the contract. Okay, like simply, writer, right, is the party who will write the contract, who creates the contract, or who sells the contract. Now, in that contract, what is written? Maybe it is written that this guy, this writer, would sell commodity, or maybe it is written in the contract that this writer would buy a commodity. But writer creates the contract. In contract, what is written? It's another story. Maybe in the contract, it's written that the writer will buy a commodity from someone, or maybe it is written the writer will sell commodity to someone. This is different thing. Okay. So writer is the party who creates the contract. Okay. And this contract could be to sell something or could be to buy something. Okay. Now here I'm coming here now. Who is the option holder now? Option holder means a buyer of the contract. Okay. Not the buyer of commodity. It generally first buyer of contract. He is taking contract. Option holder. Who will buy the contract? Obviously, this guy creates the contract. He will buy the contract from the writer. Okay, and he will accept the contract. For example, let's assume the writer wrote that he want to sell 1,000 gram gold or 1,100 ounce gold. Maybe he wrote this, and now he will accept it. Yes, he want to buy 100 ounce gold, right? So option holder is the person who will buy the contract from the writer. Okay. Actually, the second party is accepting the contract. Yes, whatever is written in the contract, so he's ready to do that. Okay. For example, if he's saying that he will sell the commodity, he would say, okay, he would buy the commodity. If he's saying that he would buy the commodity, he would accept, yes, he will sell the commodity. Right? Option holder will pay the premium to the writer. Premium is what? Premium is also called option price. He will pay some money to the writer. Why that premium or that some money? Why he will pay to the writer? The reason, the reason is written here, because option holder who hold the contract, who accepted the contract, has the option to buy or sell commodity either from the writer or from open market. So let me give you example. For example, option writer has written that he would sell gold at $100. He would sell gold at $100. Okay, in 6 months time. Now buyer, holder has accepted this. Okay, holder has accepted this contract that he would. Now here you are the holder. Okay, and you are agreeing that you will buy, okay, gold at $100 in 6 months or in 3 months, whatever time is there. So you have accepted. Now this right is with you, with the holder. Right is with the holder. Now what? After 6 months, for example, if the price in the open market is, let's assume, is $70, assume. Now this is holder is thinking that, oh, so in the market I can buy only for $70. Why I should pay this $100 which I have agreed with the writer? So what he can do, he has a choice now, he has option now, so he can just leave this option and he can buy from the open market. Okay, because he has a right. But if in the market price becomes $110, in the market price became $110, now holder is thinking, yes, he should buy from the writer at agreed price. Again, he has choice. He would buy from the writer at $100. Okay, because here the price is less. $100 which is agreed, it's less price. He is choosing that yes, he would buy from the writer. Now, writer don't have any choice. Writer has to sell the gold. A writer has to give the gain to the holder. It means this right which is called option is always with the holder. So that is why holder at start they pay the premium to the writer. They pay the premium to the writer, and this premium actually is to compensate the risk of downside to the writer. This is what it's written here. So the holder has the option, not the writer has the option. Option is with the holder. So he would buy or sell the commodity either from the writer or from the open market. But please remember, if holder chooses to buy or sell to the writer, so writer has no choice. Writer has to act according to the holder's wish. So that is why holder pay the premium, which is called option price to the writer. Understood? Now, if you will go through here, you will understand the definition here. So here we go now again definition. So option contract is a financial derivative that gives the holder the right. Gives the holder the right, not the writer the right. Gives the holder the right, but not the obligation. It's not obligation of holder. It will become obligation of writer only. It's a choice of holder, okay, to buy or sell an underlying asset at specified price, even from the writer or from the open market. This choice is with only with the holder, not with the writer. Now, please remember, writer part is over now. You don't need to worry about much about writer. So you should just remember, writer is the party who creates the contract, okay, and he gets some premium, and he it will become his obligation if holder will choose to act on the contract, okay, and the right is always with the holder. That's it. And holder always pay the premium, right receive the premium. Now here we go. Now here, okay, this I already explained to you. So now we will go through here. Now guys, types of option. How many options contract are there? Types of options contract. So first of all, it's options. Okay. So first of all, we have here one is called call option, because there are two types of option contract: call option, put option. And for what reason we are using? This is what you have to understand. They may ask you in the question. Call option is always give you right. Option means a right. Call option gives you right to buy anything. You can buy if you are, for example, if I'm taking call option from the market, I mean say from the derivative market, if I am taking a call option, it means I'm getting a right, so I can buy the specific thing, okay, because call option give you right to buy only, not right to sell. If you're taking call option, it means you are buying a right to buy something either from the writer or from the open market. It's your choice. Okay. For example, if I want to buy crude oil after 6 months, so it means I want to buy crude oil. So I should go for the call option, not a put option. Okay. Now, what is put option? Put option is the right to sell anything, right to sell. For example, I want to sell wheat after 6 months. So it means if I want to sell wheat after 6 months, I have to take the put option of the wheat. Okay, so that will give me the right to sell. So right to sell either to the writer, option writer, or to the open market. So this right I'm taking. Okay, these are two options are there. Call option always give you right to buy. If you want to buy something in future, okay, if you want to buy something in future and you have risk that the price may go up, the price may go up because you want to buy something in future, so you should go for the call option. If you want to sell something in future and you have a risk that price will go down, okay, because you want to sell something, so you should take a put option, okay, which will give you right to sell something. Here we have a note, very important, where word note is written, it means you should go through properly. If we want to buy commodity, okay, if we want to buy commodity through the contract in future, okay, in coming time, if I want to buy commodity, then I want to buy, right, I have to go for the call option, because call option will give me the right to buy. So then I will buy the contract. That contract should be a call option because that gives me the right to buy. Okay, but if I want to sell commodity, I want to sell commodity through the contract in future, through the contract in future. I want to sell commodity now. Okay, in future. So then I have to buy the contract, and that contract is called put option. Understood? I have so disclosed the two more words we have understood what is the call option and what is the put option. Okay, so now guys, here we have some more terminologies. I'm I'm going to go through with you guys. These all are relevant to option contract. While I'll do the calculations, first I'll do for the call option, then I'll do for the put option. So here we go. So guys, please remember here, there's a one terminology which is called exercise price. For example, if in the contract you have agreed $100 in the contract that something you will buy at $100 or the writer will sell that thing at $100, so the price which is written in the contract which you are going to lock with the writer, as a holder you are going to lock with the writer, so that price is called exercise price, and that is also called strike price. Exercise price or strike price. Okay, so this is the first another terminology you understood now. Exercise price or the strike price is the price at which owner can purchase or sell the assets underlying the option contract. Okay, simply the price which is agreed in the contract, that is strike price or exercise price. Now we have here option price. I told you already, option price is also called option premium, right? And who pays the premium? Who pays the premium? I'm just leaving this question for you for the comment. Premium is always paid by holder or by the writer. Can you just comment? Who will pay the premium? Holder pay the premium. Very good. So here option price, also called option premium, is the amount the buyer, means a holder, pays to the seller. Actually here please remember, don't think here buyer of commodity. No, it's a buyer of contract. Here, not the seller of commodity, it is the seller of contract. Buyer means a holder and seller means a writer. Okay, so here holder will pay the premium to the writer. Okay, to acquire an option, and option price is always based on supply and demand. And in option price, generally there are two things: intrinsic value and time value. Intrinsic value we'll see what it is, and time value we will see. Intrinsic value is the value of option if it was exercised immediately. Actually, it's a profit value. I'll show you how it is calculated. Forget about it. But just remember as a concept, in option premium, two things are there: time value and intrinsic value. Intrinsic value calculation is there in our syllabus. Time values calculation is not there. So it will be given in case if he will ask you to do some calculation. So time value will be given. Okay. Then option can be classified by their underlying asset. As I told you, in the call option and the put option, so underlying asset could be a stock, right? It could be a market index. So please, market index, I'm not sure if you have idea about it now. It's all also about the stock, maybe like a S&P Standard and Poor's 500 index in the USA. So it has shares in that index of 500 companies, right? So you are investing in the index. Okay, obviously they cannot deliver you shares of 500. So this, if exercise settlement is only by cash, since delivery of underlying is impossible, right? So they will just give you gain or loss. That's it. It is settled. Then there could be long-term stock options or index options. Please, for example, say 3 years, if you are getting options for 3 years, oh, in 3 years you can buy the stock at lock price. So these are called leaps. Leaps mean to say long-term equity anticipation securities. Okay, this just so underlying asset could be a long-term equity also. And this contract could be for 3 years. Generally, option is for 6 months, 9 months, or 3 months, right? But if you are having options for 3 years, these are called leaps. Just remember the definition. Abbreviation: leaps means a long-term equity anticipation securities. It means stock options, stocks and index options. Okay. So then underlying asset could be, as I told you, foreign currency also, right? Okay. Now guys, Then we have some other terminologies, option terminologies. So because I'll show you some calculation also, I need concentration. So there are three words are there, option terminologies. Option is in the money. This is the first terminology. In the money means say if you will exercise the option. Simply exercise option means say you are asking writer to perform his obligation and you are having profit. If you will exercise and you are having the profit, that is called option in the money. Okay, and here intrinsic value will be positive. What is intrinsic value? I'll show you. Just wait a second. So I'm just telling you here in the money means say you have a profit if you will exercise the option. Out of money means say what? You will have a loss if you will exercise the option. Obviously, if you have a loss because you got a right, so don't exercise, right? So in the money means say you are getting profit if you will exercise the option. Out of money means say you are getting loss if you will exercise the option. Add the money means say what? No gain, no loss. No gain, no loss. Okay, even if you are buying from outside market or even you are selling in the outside market, or okay, or to the writer you are buying or selling to the writer, so it doesn't make any difference. That is called option at the money. Okay, so please remember here, whenever option will be in the money, intrinsic value will be positive, and whenever option will be out of money because it's a loss, intrinsic, here we intrinsic value will write as a zero. Okay, we will not write negative. We'll write zero only because in that scenario, if you have a loss on option, you will not exercise. What is intrinsic value? Let me tell you here. First, I'm just going through the English what they are trying to tell you. Add the money means say option is exercised. Options exercise price or strike price is identical to the price of the underlying stock. So as I told you, here you will not have a no gain, no loss, right? No gain, no loss situation. So here even you are buying from the writer or from the open market doesn't make any difference because prices will be same. So now let's start. Let's do some calculations and I'm going to explain the intrinsic value here. Okay. So first I'm going to cover here call option. It would be tested in your exam. I'm telling you. Okay. And it may be tested in your exam. So most probably. So call option. As I told you, it is always call option gives the holder what it gives the right to purchase. Okay. Right to purchase means a right to call. I have already told you if you want to buy something in future date, so you should buy a call option because it will give you right to buy either from writer or from the open market, right? Okay, so you can buy any underlying assets. If you want to buy something, so you have to go for the call option, which gives you right to purchase an underlying asset at a fixed price. Now, in the money and out of money, I'll show you calculation. Don't worry. Just again theoretically, option is in the money. In the money means say if you will exercise, you have a profit. So when you will have option in the money, if price of underlying means say in the open market is greater than exercise price. Guys, remember you are buyer here, right? You are going to buy commodity. For example, in the option price is written $100, but in the open market is $120. Obviously, here if you will exercise the option, so you have a profit, right? Because you are buying at 100 only. But if you buy from open market, you will pay 120. So in this scenario, whenever price of underlying asset in the open market is greater than exercise price. So, okay, so this is called in the money because if you will exercise at 100, if you will buy at 100, you got a profit, right? Then out of money is what? For example, again, you agreed a price of $100. Now see here. Now see here. For example, you agreed the exercise price $100, which is strike price, but in the market now it is $90. So now see the price of underlying in the open market, which is less than exercise price. What do you think? Because you want to buy something. So should you buy at 100 or 90? Obviously at 90. In that scenario, you will not exercise the option. That's why it's called option is out of the money. But the point is how we would say in the money and out of money. This is theoretically I said first. If price of underlying asset is greater than exercise price, it is in the money. If price of underlying asset is less than exercise price, it is out of money, and same result we can get through the calculation, and that is more easy. Okay, that is more easy. So let me just tell you first that thing, intrinsic value how you will calculate, and then I'll come back to the long and short position. If you want to calculate intrinsic value, it will make you life easy more. Intrinsic value, okay? So under call option, I'm talking about, not put option. We'll see in the next class. Only call option I'm talking about. Right to buy. Call option is right to buy. This is the formula you will apply to calculate intrinsic value. How? Market price minus exercise price. And you can decide, are you having profit if you will exercise, or are you having loss if you will exercise, or there is no profit, no loss if you will exercise. Okay. And this will help you to decide option is in the money, out of money, or at the money. So here we go. Very simple. Apply this formula. Intrinsic value equals market price minus exercise price. Intrinsic value, simply you can say it's a value of profit. Market price minus exercise price. So there here I'm writing here intrinsic value equals open market price minus exercise price. Exercise price is also called strike price. Understood? So this formula you will apply. And for example, if strike price is $10, like agreed locked price in the call option is 10, but in the open market it is $12. Now I need your concentration. What do you think? If you, because you are dealing with a call option. Call option means that you want to buy something. You want to buy, you have a right to buy. What do you think? You would buy at 10 or you would buy at 12? Can you send me the message? Would you buy at 12 or 10? What is preferable for you? Okay, so you would buy at 10, right? It means here, tell me, you should exercise the option or not? One more question. Yes, we want to buy at 10. So I should go for the option or I should go buy from the open market? Tell me. Option or open market? Option. Very good. Here we go. So that is why when I will do this open market price minus exercise price, like for example, in the market it is 12, but I can buy through the contract at 10. So this is here, it means intrinsic value is $2 positive. So whenever intrinsic value is positive, obviously when market price is greater than exercise price, right? So whenever intrinsic value is positive, so we will say option in the money. It means we have a profit if we will exercise the option. That's it. This is what it means, intrinsic value and option in the money. And other scenario, for example, now your locked price is $12. You agree 12, but in the market is 10. And again, you want to buy something. Would you buy at 12 or 10? Obviously, you should buy at 10, right? Not at 12. You should buy at 10 here. Now here, it means you should not go for the option, right? You should not buy through the contract. Okay, just buy from the open market. So that's why here we would say option out of money. And intrinsic value is negative 2, but we will not write negative 2. We should ideally write 0 here. Why? Why? Because I'm not going to exercise the option, right? So I'm going to buy from the market. So here intrinsic value is negative. So intrinsic value cannot be negative. It should be 0 only. So wherever you are getting negative intrinsic value, put 0. 0 means say this, if market price is less than exercise price, so then this is called option is out of money. So you will have a loss if you will exercise the option, right? Because negative intrinsic value was there. So we should leave the option and we should go to the open market. Understood? Then we have here, for example, now one more example, and then we'll do quick calculations. Okay. Third scenario is this scenario number 3. Let's assume you agreed the exercise price $10 and in the open market is also $10. Now it doesn't difference, right? Doesn't make any difference. Either you are buying from the contract, means from the writer or from the open market. So that is why here intrinsic value 10 minus 10 again 0. So option is add the money. This is called add. Add means no profit, no loss if you will exercise the option. Option in the money means say you will have a profit if you will exercise. Option out the money means say you will have a loss if you will exercise. And option at the money means say no profit, no loss. Doesn't matter. Okay, so please remember intrinsic, if intrinsic value is positive, then we should exercise, right, the option in as in case number 1. Okay, and in case number 2, if you feel intrinsic value is negative, so we will put 0 here. We will not write negative figure. We'll write 0. Okay, because we are not going to exercise. In that scenario, don't exercise the option because you will have a loss. And in case of intrinsic value, if actually it is 0, So then doesn't make any difference, right? So it means we should exercise only in one scenario when intrinsic value is positive. So that is why sometimes it is written in the books that intrinsic value could be positive. It could not be negative, right? Because in case of negative, you will leave the option. So there is no loss to you because you have a right. Okay. Now continues. These all things will be tested in your exam question. Now please remember here, how would you calculate the gain or loss? Okay, gain or loss. Please remember here in the call option, we got a writer and we got a holder. Call option always give the right to buy, this right to home to the holder. Okay, who it means who is buying here? Holder. So holder will always have a long position. Okay, because whoever is going to buy something, so that person is having long position, I told you earlier. And the person who is going to sell, because if holder is going to buy, it means writer has to sell the commodity or the underlying asset. The seller always have a short position, right? So that's why they told you here. And please remember, right, as I told you earlier also, the gain of one party will be exactly the loss of other party, or the loss of one party will be the gain of other party, right? But the question is, this may test in your exam, how would you calculate gain or loss? Okay, and try to understand the formula. It's all logical. Just you have to think and see how it works. Okay, and after obviously after understanding, you have to memorize this also. If you don't memorize, you will do mistakes. So first I'm talking about from holder point of view. Holder. Okay. Uh, Holder means a buyer. Buyer will have long position. I told you at the start. Okay. Okay. Now holder. Holder I'm going to talk about who is the buyer. Okay. Who is going to buy, who is having right to buy. So how he will calculate gain? Number one, first of all, look at here. Option price. Option price means a premium. I'm just starting in the reverse order little bit. Actually, this price you have already paid, right? You have already paid as a holder to the writer, right? So this was your cost. Agreed? This is your cost, right? You have already paid when you took this contract. Okay. So this is paid by holder. Okay. So try to understand what I'm saying. I'm just starting in the reverse order because you have to understand the first component of the formula. So it is option price means it's a premium, and this is the cost to the holder. I'm talking about holder point of view, right? Because he has already paid. Now what? What is this side of the formula? It's written market price over exercise price. It means market price minus exercise price. Actually, this is the intrinsic value. The excess of market price over exercise price. It means your intrinsic value will be positive, right? Because market price minus exercise price. It was intrinsic value. If you don't remember, I'll show you. Market price, market price and exercise price, right? Excess of market price. If you look at here, excess of market price over exercise price. So excess, if it is 12 market price, exercise price is 10. So excess is 2, right? Excess. Okay, guys. Excess. Okay. So this is what it means they're talking about here positive intrinsic value. Positive intrinsic value. Okay. So here we go. So excess of market price over exercise price. So it means they're talking about positive intrinsic values. It means this is actually a gain. Sorry, let me remove. So it means uh, if I'll take this market price minus exercise price, it means it's an intrinsic value, positive intrinsic value, because I'm taking excess, right? Excess. It's a positive intrinsic value. This is a gain to me. And this is the price option premium, which I have already paid. This is the cost to me. Okay, so if I'll take gain minus cost, it will give you net gain, right? Net gain, right? Net gain. And this net gain, I'll multiply with the units of underlying. Underlying means let's assume number of shares. Let's assume this is the net gain per share because I got gain on one share, which is this, and premium is the cost of that share. If I'll net of this is net gain per share. If I'll multiply with the units of underlying, means a number of shares. So this will give you total gain figure, right? Understood? Okay. And please note it here. If your if your market price is $10 and exercise price is $12, so look at here, this intrinsic value is negative. So in that scenario, you will keep this side of the figure zero and minus option price or premium which you have paid. Okay. Because if your intrinsic value is positive, then you will write positive intrinsic value. If it is negative, then put it zero here. That I'll show you with the example also. Don't worry. Now you have to think from writer. Number one, writer, option writer. Option writer has received the premium, right? He has received the premium from holder. So it means the option price or premium was income for the writer, right? And from this income, now we will deduct. What we will deduct? Excess of market price over exercise price. Because excess of market price minus exercise price. Again, it is intrinsic value and it is a positive intrinsic value. Excess, okay, of market price over exercise price. It's a positive intrinsic value we are taking. Okay. So actually this, if there is a gain to the holder, obviously it will be a loss to the, it will be a loss to the writer, right? So now option premium he has received, it is income, and this is the loss to the writer. So income per share minus loss per share, this will give you net income or net loss, and this you will multiply with the units of underlying, means with the number of shares, so you will get total loss or gain. So please remember, I'm saying one more time. So we just, if you look at the formulas are quite similar, just their component placement at the different place. Like we are just putting component at different place. Look at here. Here first we are taking excess of market price minus exercise price, then minus option price, right? Here we are taking option price minus excess of market price over exercise price, right? And then we are multiplying with the underlying number of units. So there's a slight difference. Okay. Now let's go through with the help of questions so you will understand what I was saying. Don't worry. It's very quite simple. Let's go through the example here. So we got a example here. For example, T company bought a call option. Okay, it's a call option. Giving its right to buy. Okay, how many shares we want to buy? Number of shares 100. So this is number of underlying assets. Number of underlying asset and number of shares. Number of underlying asset and number of shares. 100 shares. We got a call option. 100 shares of P company. Who got this option? T company. He will buy 100 shares of P company in 30 days. Okay. At $100 per share. This is the strike price. You locked in price. S company. This is S company sold these option to T for $3 per share. Maybe this T company bought this option from the S. Okay. And they paid for $3 per share, means this is the premium which we paid per share $3. Premium. Okay. Then on day 30, maybe here S is the writer, right? S is the writer, T is the holder, and they are dealing the shares of P company. Underlying asset is shares of P, but T is the holder, S is the writer. P company, now P is whose stocks are there, whose underlying asset is there. P's stock is trading at 105. That's it. What if, my question is, what if the actual market price is $105 in 3 months, in 30 days? So how you will do it now? We'll move to the formula. First of all, I'll write it here from holder point of view. We'll do the calculation. Okay, don't worry. Holder. Holder paid option price $3. So minus 3, it's premium. Now excess of market price. Market price is 105 and exercise price is 100, right? $100. So it means here intrinsic value is 100 and 105 minus $105 positive. So this positive is the gain to the holder now because he would buy at 100, because in the market price is 105, so he's buying at less price, so he's got a $5 intrinsic value. So this is answer for this side is 5. This is the gain minus 3 which he has paid. So net gain is 2, right? If I'll solve this whole side, it is net answer is 2. 2 I'll multiply with the number of shares which are 100 shares. It means 100 times $2 gain, so it is $200 total gain, right? Now you can see here. Calculation. $200 gain to the holder. To the holder. Okay. Now similar formula you will apply for the writer and go back to the formula. That's why I told you it's important to memorize the formula. Okay. Now for the writer, because writer first of all he received the premium of $3, so it was income for him, and now he is incurring a loss because here he got a gain of $2, right? And if you will take it here, market price over exercise price. So market price is 105, exercise price is 100. Now what? Because holder will exercise the option, right? Because intrinsic value is positive. Because how you got intrinsic value? Market price minus exercise price. So it's intrinsic value. So whenever intrinsic value is positive, so holder will exercise the option. So market price is 105, exercise price is 100, intrinsic value is 5. Obviously, holder will exercise. If he will exercise, he will get a gain, and this person he will have a loss. Writer will have a loss. Okay, 100 minus 100 because he's selling thing at 100, which is market value 105. So he's incurring a loss of 5. So this is the loss. Okay, and here he received something. So net loss he got $2 because he received $3 premium, but he's losing $5. $2 is a net loss, right? Negative figure, negative, right? 3 minus 5 is -2. So this -2 once you will multiply with the number of underlying, which are 100 shares, so you will get a loss of 200. Obviously, the gain to one party will be the loss to the other party, right? Clear? Okay, now see here, tell me option was in the money or out of money? Just another question. By using this data, when you calculate intrinsic value from holder point of view, it is market price minus exercise price. Market price is 105, exercise price is $100, and intrinsic value is 5 positive. So whenever positive intrinsic value is there, it means option is in the money, right? Understood? If intrinsic value is negative, it is out of money. And negative intrinsic value we will not write. We will write zero there because we will not exercise. So let's do another example. This is for out of money call option. Assume same data again. We have a strike price of $100 and we have underlying assets. We have 100 shares. These are dollar. Okay. And this is strike price. And we have actual market price. Now I'm assuming actual price. Actual price is what we can assume here. It's 97, for example, 97. So tell me first calculate the intrinsic value. Intrinsic value. Like to decide as a holder, should I exercise the option or not? Intrinsic value formula is market price minus exercise price. Market price is 97. Exercise price is 100. So intrinsic value is -3. 3 means a 0. I will write. It means I should not exercise the option. I should not buy at 100. Okay. I should buy from the open market at 97. So I should not buy at 100. So I will leave the option. It means option is out of money, right? But how you would calculate gain or loss? So here you will make mistake and don't make mistake. I'll go back here to the formula. Again, these two formulas are there and see how I am applying. Trust me, we spend a lot of time and maybe we studied only 2 pages of your book. Okay? Because it is really complicated to communicate as well, this topic. Okay, so guys, 2 or 3 pages max we studied. So now guys, if you look at here, first don't forget this data. I will calculate intrinsic value, which is market price minus exercise price. Market price now 97, exercise price 100. So intrinsic value is -3. Technically it's 0 because I will not exercise the option. So what I'll do here now, how I'll calculate the gain or loss? First for holder. So intrinsic value, this is excess of market price over exercise price. This is actually intrinsic value. I'll keep intrinsic value 0 here. I'll not write -3, okay? I'll keep it 0 because I'm not going to exercise. Minus option price, which is $3. So 0 minus 3, it is -3 because this premium I have already paid. Number of underlying asset, 100 shares. 100 times -3, it will give you 300 loss. 300 loss. And obviously now for the writer, because holder will not exercise, okay, and the writer will not sell the shares, then obviously then what option price will be here? He has received $3 minus. Here again intrinsic value we will put 0 because we cannot write negative. So 0. So 3 minus 0. Okay. Times number of shares, how much? $100. 100 shares. Again, he will have again, because this is a positive. He has received $3 as a premium. And that is going to be with him only now with the writer. Okay, because sell holder is not going to exercise the option. So he saved 300. It will become again. So what you understood, if intrinsic value is negative, you will put 0. Okay, this is what is the main point here. Clear, guys? I hope so it is clear. So we have done this other example also. We got a gain or loss. Now, last thing I'm going to explain, which is graph. I'm not sure they will ask you in the question or not, but it is my duty to explain. So here I told you, here we buyer got a loss of 300, holder I meant to say, and writer got a gain of 300, and I have shown you just calculation above. Understood? That's great. Now, guys, we have here, this is diagram, like let me explain it, how much you will understand. Just try to pick it here, okay? Just see what I'm explaining here. For example, guys, this x-axis, okay, so is your price of underlying. So you can quote any figures here. For example, price of underlying is, I'm just writing it here, 10, or let's assume 40, 80, 120. I'm just writing, okay? Let me write properly, guys. So for example, it is, here we have a 10, here we have a 20, 30, and so on. Up here we have a 100. Okay, here we have 110, for example. Here we have a 120 and so on. Okay, just prices we are writing. Just less space. I'm just saying it's 10, 20, 30, 40, 50, 60, 70, 80, 90, 100, 110, 20, 30, so on. Okay, this is on x-axis, and on y-axis, for example, I'm putting here figure of gain or losses. Okay, and again you will write it here, for example, 10, 20, 30, 40 till 100 or 500, whatever. So then here you will write, this is the loss side, mean to say. From here, if you'll move down this negative side, like minus 10, minus 20, minus 30, minus 40 till 100. Okay, I hope so just you got the idea what how data is placed. Okay, so and here, because this is your price of underlying, this is your price of underlying. Okay, now what I'll do, I'm assuming two things here from my example, that strike price is $100 and premium I have paid $3. Okay, so I'll put a total, if as a holder, if I will exercise the options, the total I have paid $103, right? Because $100 I will pay once I will buy the shares, $3 premium I have already paid. So total price is, total the price which I will pay 103. So here we got two dot here, okay? Okay, so what we got here? So here we got, this point is, this point is your price is 0 here at this point, right? At this point your price is $100. We got one thing, this is exercise price, and then total price, because I have paid premium here, so I will put one dot on exercise price plus option price, means say it is strike price plus premium total. So one dot is there, right? Just we placed it as per data. Okay, now think here, and here I'm putting here, you can see here gain and loss $3. This $3 is the premium, right? Which, because which holder has paid and writer has received, right? So we put just $3 positive also and $3 negative also. Just we wrote, because this $3 will become your gain or loss. And now here we go. Please try to understand here now. Please remember this, I'm explaining call option. Which option? Call. What is the strike price? 100. 100 is a strike. Right to buy. Right? Right to buy. Okay. What if, try to understand here. What if actual price is less than $100 in open market of the shares? Understand here. Strike price is 100, which is dot here. If the actual price in the open market is below 100, maybe 95, let's say maybe 95 or maybe 90 or maybe 80, below 100, it's less than 100, which is strike price. Tell me, tell me who is in the gain in this scenario and who is in the loss. Just think logically, because it's a call option. If you will buy through the contract, I mean, so through the option, you will pay 100. But if you will buy from the open market, you would pay 95. Let's assume price is 95. Okay. Now tell me, would you want to buy at 100 or 95? Definitely you would buy at 95, right? It means what? You will leave this option, right? If you will leave this option, tell me as a holder what you are losing. You are losing only premium, right? $3. So that is why if your actual price is lower than strike price, means say to this side, okay, because this side is lower than strike, right? This side lower than strike because strike price is here. If your actual price is lower than strike, so what will happen? So the buyer will have a loss if he will exercise the options. Obviously, he will not exercise the option. So then he will buy from the open market, right? In that scenario, he will lose $3. He will lose $3 of the premium which he has already paid. And because he is not going to exercise the option, okay, so writer has received already $3, it will be a gain. So this is the story. Story is if actual price is lower than strike price, so here seller will get a premium, buyer, that is income for seller, and buyer will it will be a loss for the for the holder because he has paid the premium, and option will not be exercised if the price is below the excess strike price. Please remember, option won't be exercised. Seller will finally get $3 of premium, which is gain to seller, to the writer. Okay. And the buyers means say the option holder, he has paid already $3. So because he's not going to exercise the option, so he lost that. Okay. Then what? If think now, if now actual price is exactly how much? For example, more than 100 or more than 103, because 103 is your break even point for the holder, right? 103 is your break even point because 100 strike price you will pay plus $3 premium you have paid. This is your break even point. Now, what if the price will be more than break even point 103? Okay. If price has increased, let's assume now the prices are to this side. Prices has increased now is more than 103, more than 103. What will happen? Assume here, put the figure. For example, the price in the open market is for example 110. Tell me, would you in the open market, like because it's a call option, if you will buy from the open market, it's $110 you will pay. But if you will buy from the writer, you will pay $100. So tell me, would you exercise the option? Yes or no? Yes, we should exercise the option. We should buy at 100. So if the price is more than break even point, if actual price is more than break even point, so who will get a gain? Obviously, there will be a gain to the home, to the buy, to the holder. It will be a gain to the option holder. Okay, to the holder. This will be a gain to the holder if price is moving more than break even point. And obviously, it is going because he will exercise the option. If he will exercise the option, it will be a loss to the writer. This is what is the graph. Okay, I hope you understood. So this is just a curve. If strike price is below in call option, if strike price is below the access, if sorry, if actual market price is below the strike price, which was 100 here, so who will have a gain or loss? Who will have a gain or loss if it is lower? If you are into this side, so writer will have a gain, buyer will have a loss of premium. But if the prices are moved beyond the break even point, which includes exercise price plus option price, so then who will have a gain or loss? So buyer will have a gain. Buyer means a holder will have a gain. Here is a holder and writer will have a loss. Okay, holder will have a gain and here writer have a gain and holder have a loss. I hope you understood, right? This is the graph. Clear, guys? I know, guys, it is too much things, too much difficult. So what I'll do in the next class, I'll teach you first put option and its graph, and then we'll go through some questions specifically related to option, and then we'll go through other things. Okay? If you have any question, you can ask me. Thank you.